London. September 1720. In a single afternoon, Britain lost more wealth than it spent fighting a decade of war. Thousands of families were destroyed. Fortunes evaporated. Suicide notes written in mansion libraries. This wasn't an enemy invasion. This wasn't plague or famine. This was money itself. It's turning into air. The year is 1711. Britain just survived the War of Spanish Succession. 13 years of brutal fighting across Europe. The enemy, France and Spain, the old Catholic powers. Britain won. But victory came with a price. The national debt stood at nearly £10 million, an unimaginable sum. The government borrowed from anyone who would lend. Soldiers waited months for pay. Creditors circled like wolves. Parliament faced a crisis. How do you pay for a war when the treasury is empty? Then came an idea, brilliant, dangerous, seductive. What if you could turn debt into profit? Enter the South Sea Company, founded in September 1711 by Robert Harley, the Lord Treasurer, and John Blunt, a businessman with ambition burning in his eyes. The concept was simple, almost magical. The British government would give the South Sea Company a monopoly. Exclusive rights to trade with South America, with the Spanish colonies, gold, silver, exotic goods flowing from the New World directly into British hands. In exchange, the company would absorb Britain's war debt. It would take over the government's crushing financial burden. Creditors holding worthless government IOUs could exchange them for South Sea Company stock. Paper debt transformed into shares of future riches. It sounded like alchemy, turning lead into gold. The South Sea. The name itself sparkled with promise. Endless oceans. Ships heavy with treasure. Markets hungry for British goods. There was one small problem. Spain controlled South America. Spain, Britain's recent enemy. Spain wasn't exactly opening its ports to British merchants. The trade monopoly? Almost worthless in practice. But John Blunt understood something profound. Something that would echo through financial markets for centuries. Reality doesn't matter. Not really. What matters is the story. What matters is belief. 1720 arrived like spring fever. Across London, coffeehouses buzzed with a new language. Stock prices. Share values. Percentage returns. The South Sea Company announced a bold new plan. They would take over even more government debt. Nearly the entire national debt of Britain, £30 million. Think about that. One private company offering to absorb a nation's financial burden. Parliament debated. The King's ministers whispered in corridors. Behind closed doors, South Sea Company directors made promises, made deals. They bribed members of Parliament with free shares. They offered the King's mistresses guaranteed profits. They painted visions of wealth beyond imagination. In January 1720, Parliament approved the scheme. The market went insane. South Sea's stock in January, £128 per share. By March, £330. Ordinary people mortgaged their homes to buy shares. Dukes and duchesses lined up outside Exchange Alley. Servants used their wages to gamble on the market. The company directors whispered rumors. New trade agreements with Spain. Ships are already sailing. Warehouses filled with gold. None of it was true. May 1720. The stock hit £550 per share. Isaac Newton, the greatest scientific mind in Europe, bought shares. "I can calculate the motion of heavenly bodies," he said, "but not the madness of people." Even Newton couldn't resist the dream. The South Sea Company kept issuing new shares, more stock, more chances to get rich. Each new offering sold out instantly. June 1720. The price climbed to £890 per share, up nearly 700% in 6 months. Exchange Alley became a circus. People are shouting, pushing, fighting for the chance to buy. Women in silk gowns standing shoulder to shoulder with apprentice boys. The king himself owned shares. The Prince of Wales, half of Parliament. Everyone was winning. Everyone was going to be rich. June 24, 1720. The South Sea Company stock touched £1,050 per share. Peak. Absolute peak. Then something shifted. Few clever investors started selling. Quietly, carefully, they'd been watching the numbers. The company had no real profits, no actual trade, just promises in paper. The directors noticed. They panicked. They spread new rumors, bigger than before. Spain would give them 3 entire cities, trading posts from Mexico to Peru, dividends of 50% annual returns. The stock held steady through July, £900. Still astronomical. But whispers started in the coffee houses. Where are the ships? Has anyone actually seen South American gold? What does the company really own? August arrived. Hot, tense, uncertain. The stock began to slip. 900, then 870, then 800. Some investors rushed to sell. Others bought the dip. This is our chance, they said. Buy low. It will rise again. John Blunt stood in the company's headquarters, watching the price boards. His face was pale. His hands were shaking. He knew the truth. There was nothing underneath. No gold, no trade, no substance. Just belief, just hope, just the greater fool theory. And belief was starting to crack. The question hanging over London as summer faded: how far can a stock fall when it was never really worth anything to begin with? September 1720. London held its breath. South Sea Company stock trembled at £750 per share, down from its peak. But still, 7 times higher than January. Investors told themselves stories. It's just a correction, they said. Fundamentals are strong. What fundamentals? No one could quite say. The cracks widened fast. Early September, a handful of major investors dumped their entire holdings. These weren't nervous amateurs. These were company directors, the insiders. They knew the ship was sinking. They were grabbing the lifeboats. September 8th, the stock fell to £670. Panic rippled through Exchange Alley. The comfortable aristocrats who'd invested their estates. The merchants who'd borrowed against their businesses. The servants who'd bet their life savings. They all rushed to sell at once. September 12th. £580 per share. The company directors held an emergency meeting. Candlelight flickered across worried faces. John Blunt paced the room. "We need to restore confidence," someone said. "Spread more rumors about Spanish agreements?" The market didn't believe them anymore. September 14th. £500. Banks that had loaned money against South Sea shares started calling in loans. "Pay us back now." But the collateral was worthless. A share bought for £900 was now worth $500. And falling, families received letters. Cold, legal, final. Your property will be seized to satisfy the debt. September 20th, £400 per share. The suicides began. A merchant in his counting house. A rope. A note to his family: "I have lost everything." A gentleman in his study. Poison and wine. His estate mortgaged 5 times over for shares now worth nothing. The newspapers didn't report these deaths. Too common. Too shameful. Parliament reconvened in an emergency session. The MPs who'd taken bribes stayed silent. Guilty. Terrified. The king's advisors scrambled. This wasn't just a market crash. This was a threat to Britain's entire financial system. Banks were failing. Credit froze. No one would lend money to anyone. The goldsmith banks along Lombard Street shut their doors. No withdrawals today. Customers pounded on locked doors, screaming for their deposits. October has arrived, cold, gray, merciless. South Sea stock, £290. Isaac Newton sold his shares. Final loss, £20,000. 3 years of his salary as master of the mint, gone. "I will never speak of this again," Newton said. And he didn't. The company tried one desperate move. They convinced the Bank of England to support the stock price. Buy shares. Create artificial demand. The Bank of England agreed. For a price, they wanted concessions. Control, power. It didn't work. October 1st, £200 per share. The aristocracy who'd invested discovered something horrifying. They'd bought shares on credit, installment plans. They'd paid only a fraction up front, promising to pay the rest over time. Now the bills came due. They owed money for shares worth 1/10 of the purchase price. Estates went up for sale. Manor houses, ancestral lands. 300-year-old family holdings sold to pay gambling debts on worthless paper. October 15th, £175. The government investigation began. Parliament formed a committee, the secret committee they called it, led by men with clean hands. Men who hadn't taken bribes. They demanded records, account books, transaction ledgers, lists of who received what. The company directors refused. Proprietary information. Parliament issued warrants, threats, produce the books, or face prison. October 30th, 1720. John Blunt appeared before Parliament, stood in Westminster Hall, the same hall where kings had been crowned, or traitors had been condemned. Where did the money go? The committee chairman asked. Blunt's hands trembled. The money was invested in future trade, in promises from Spain. What promises? Show us the contracts. Silence. Show us the Spanish agreements. More silence. The truth emerged in pieces. Painful. Undeniable. There were no Spanish contracts. No trade agreements. No warehouses of gold. The company had created paper wealth from nothing, sold shares to itself, manipulated the price higher and higher. Directors had sold at the peak while ordinary investors bought at the top. It was fraud. Systematic, calculated, massive. November 1720. South Sea stock, £135 per share, down nearly 90% from the peak. The rage in London became physical. Crowds gathered outside company headquarters, throwing stones, shouting for blood. Hang them. Hang the directors. Guards protected John Blunt's house. Mobs threatened to burn it down. Stop leaving. Stop sleeping. Parliament debated punishment. Execution. Prison? Exile. The king's advisors whispered, "Careful. Many powerful people are implicated. Members of your own government. Your own family." The investigation dragged on through November. Into December. Witnesses testified. Documents revealed the scope of corruption. Cabinet ministers had taken bribes. The Chancellor of the Exchequer, the Postmaster General, the King's German mistresses. The scandal reached into the highest chambers of British power. Christmas, 1720. South Sea stock traded at £124. Families that had feasted on roast beef the previous Christmas now begged for bread. Children who'd worn silk now shivered in patched wool. Britain's financial system lay in ruins. Trust destroyed. Credit collapsed. Machinery of commerce grinding to a halt. But the reckoning had only just begun. The question now wasn't how to restore the market. The question was, how do you punish the guilty when the guilty are everyone who matters? January 1721. London woke to a new reality. The dream was over. Now comes the bill. South Sea Company stock drifted at £120. Some investors still held their shares, hoping, praying for a miracle that would never come. Parliament's secret committee published its findings. February 1721. The report detailed systematic fraud. Company directors had embezzled millions. It created fake accounting entries, issued shares to themselves at discounted prices, then sold them to the public at inflated values. The directors had personally profited by over £2 million, while the nation lost nearly $30 million. The public demanded justice, real justice. Parliament passed the South Sea Sufferers Act. March 1721. Every company director's personal assets were seized, estates confiscated, bank accounts frozen. John Blunt, who'd lived in a mansion, was left with £1,000. Barely enough to survive. Other directors fared worse. Their entire fortunes taken. Families thrown into poverty. One director escaped to Europe. Another died before trial. Third went mad, wandering London streets, muttering about ships that would never arrive. But the punishments felt hollow, inadequate. The money was gone, vanished. You can't recover. Wealth that never really existed. The government tried to stabilize the financial system. The Bank of England and the East India Company absorbed what remained of the South Sea Company, broke it apart, divided the pieces. South Sea stock would technically trade for another century, but at prices barely above the cost of the paper it was printed on. The immediate damage rippled across Britain's economy. Banks that had survived the crash became ultra-conservative. No more risky loans, no more speculation. Credit became scarce and expensive. Business activity slowed. Merchants couldn't get financing for shipments. Manufacturers couldn't expand. The British economy contracted sharply in 1721. Unemployment rose. Wages fell. The social fabric tore. Families that had climbed into the middle class tumbled back into poverty. The nouveau rich became the nouveau poor. Trust evaporated. People stopped believing in joint stock companies, stopped believing in paper promises. Returned to land, to gold, two things you could touch. Parliament passed the Bubble Act in June 1720, actually before the crash, prohibiting unauthorized joint stock companies. They wanted to limit speculation, protect investors. Ironically, the act destroyed legitimate businesses too. It capital formation difficult, slowed economic innovation for decades. One victim stood out. Isaac Newton never spoke of the South Sea Company again, but his behavior changed. He became obsessed with counterfeiting. As master of the mint, he hunted down fake coin makers with unusual cruelty. He sent men to the gallows. Perhaps he saw in counterfeiters what he'd seen in himself, the belief that you could create value from nothing. The lie that paper could become gold through clever tricks. But the South Sea Bubble changed more than Britain's economy. It changed how the world thought about finance itself. Before 1720, markets were mysterious, almost magical. People didn't understand speculation, didn't have words for bubbles or crashes. After 1720, they did. The South Sea disaster became a reference point, a warning. When markets soared too high, people whispered, "Remember the South Sea." Parliament reformed financial regulation, slowly, imperfectly. They required companies to publish accounts, banned certain forms of stock manipulation, created transparency rules. The Bank of England emerged stronger. The crisis proved Britain needed a central bank, an institution that could stabilize markets in a panic, lend when no one else would. This institutional evolution mattered. A century later, Britain's financial system would fund the Industrial Revolution. Railways, factories, global trade networks. That system was built on lessons learned in 1720, on reforms written in the ashes of the South Sea Company. Other countries watched and learned. France had its own bubble the same year, the Mississippi Company. John Law's scheme. It collapsed similarly. The Netherlands, with their history of tulip mania in 1637, saw the pattern: speculation, euphoria, crash. The cycle repeated across borders and centuries. Financial theorists studied the South Sea Bubble for generations. They built models trying to explain it, trying to predict the next one. They never quite succeeded, because the heart of every bubble isn't rational. It's emotional. It's the belief that this time is different, that the old rules don't apply, that wealth can multiply infinitely if you just believe hard enough. The South Sea Company scandal taught the world a brutal lesson. Markets can be manipulated. Paper can lie. The difference between confidence and con game is sometimes just 3 letters, but the deeper lesson, harder to accept. Every financial bubble requires 2 things: the schemers who create it, and the dreamers who believe in it. John Blunt couldn't have built his empire without millions of willing investors, people who wanted to believe the impossible, who ignored warning signs because the story was too beautiful to question. We remember 1720 because it's still happening. Different names, different markets, different technologies, the same human psychology, the same intoxicating promise, the same eventual crash. The South Sea Bubble wasn't a historical anomaly. It was a preview, a template. Every boom and bust since 1720 echoes that original disaster. The dot-com bubble, the housing crisis, the cryptocurrency mania, because the lesson of the South Sea Company isn't really about economics. It's about human nature, about greed and fear, about the stories we tell ourselves when we want something to be true badly enough. And that's a lesson every generation has to learn for itself, usually the hard way. If you want to understand how money really works, how markets really move, how financial power really shapes history, subscribe for more deep financial history documentaries. Because the past isn't the past. It's just waiting to repeat.